Hello, and welcome back to Good CEOs Season 2, Episode 2. Now, for those of you that have been paying close attention, you'll be aware that this season is all about creativity and capital. So, the first episode, we've had James Greenfield. The next episode, we invited a man called Matt Lacey, who is the managing partner of Waypoint. Now, Matt focuses day in, day out on buying and selling and helping companies merge in the creative economy. He's been doing it for decades, and he is a wonderful, wonderful person that is really open and honest, which can be quite rare to find in the land of M&A. So Matt and I dive in. We dive in about what makes a company valuable. Why are we seeing this flood of private equity money into the industry? How do you know when is the right time to sell your business? How do you know when the right time is to look and explore different options? We speak about the macro economy. We speak about where we're seeing the most amount of growth. We talk about the principles that you apply when you think about buying a company, selling a company, growing a company, everything. So I really, really, really enjoyed this chat with Matt. We were both energized. We had a lot of fun. And I really hope you enjoy this. This is, if you are a founder of an agency, or you want to become a founder of an agency, or perhaps you're thinking of starting an agency with a bunch of friends, this is the podcast to listen to, because you can think about and hear about what it takes and what you can expect when looking at taking investment and growing your own business. So please enjoy. Let us know what you think. Let's get into it. Matt Lacey, managing partner of Waypoint.
Indeed. And thank you
Indeed.
for having me on, Ollie. It's a pleasure. And looking at the guests you've had on, it's quite a lineup. So I'm extremely excited to have this chat.
Well, I'm glad you mentioned previous guests. And I was also going to say, Matt Lacey, first and foremost friend, second
Of
friend of
course.
unknown. But we've known each other for a year and a half now, and I've really enjoyed getting to know you. As a friend, but also a business partner, and you are the man that I come to when there are any questions I have around the wonderful world of M&A, mergers and acquisitions. And the more we sort of work together, the more I find out I don't know, and therefore learn so much from our conversations, which is why I've brought you on to season 2 of Good CEOs, which is all about creativity and capital. So what we're doing is we're bringing on founders that have taken capital, and then we're speaking to people like yourself that are capital professionals and work with agencies to help them accelerate and grow and achieve all their wonderful dreams. But why the hell should our good CEOs trust this random man that we've invited on the podcast? So I'm going to start very gently, and I'm going to I'll ask you 2 questions. The first question is, what is the work that you've done? It could be recently or like of all career time in the M&A space, particularly in the M&A agency space, that you are personally most proud of?
Is that starting soft?
Yeah, man.
Wow. That sets the tone for the future of this.
Yeah. Welcome. It's going to be like Newsnight, but worse.
Yeah, yeah. Well, look. First of all, as I said, thanks for having me on, and it's been a great relationship. I think it started off as a random chat, right, about nothing in particular, and just spitting the breeze. And look, I've learnt a lot from you as well, Ollie. It's definitely a two-way thing. What am I proud of? It's a really tough one. There's loads, honestly. I think, the position that we've got, without plugging us too far, as Waypoint, and where I've taken it and where I've been able to bring the business to, I think is a really proud moment. I look back at my career, and I started in the world of TV, M&A, and sort of content world, traditional entertainment. And the latest deal of Afterpart is a great one. It was really sort of personally the one that I've been waiting for in many ways. It's that combination of what I thought were two worlds coming together. The sort of entertainment space meets brand and talent. And at some point I thought I just got that completely wrong. I did think they were going to merge and sort of start to collide a lot earlier, but it's nice to see it. So that was a big highlight. Obviously, the sort of big names of OK Cool, it's a brilliant deal to be involved in, super fun, fantastic people. So look, there's loads of deals that we could talk to, but it's sort of just being in a space that's so entrepreneurial and creative. Honestly, the best part of it is meeting new people and sharing thoughts with them.
So when you say you're proud of these deals, obviously those are interesting, I think, industrially, because as you mentioned, we're seeing this new kind of. If I describe to you what after party studios are to you in 2010 or whenever it is that you got involved in the industry, it would have sounded quite confusing and side hustly and
Yeah.
like, oh,
Yeah.
there's
Yeah.
this kind of IP and YouTube, and you got the Sideman, and which wouldn't have even been a thing back then. And then OK Cool again is a similar one, right? 10 years ago, a social first creative agency was the bolt on to an ad agency,
Yeah.
and they kind of got a bit of a go at the brief if the ad creatives had a bit of time to bring them in. So that's definitely industrially changed, and I think we've seen a huge change there. But I guess I'm probably more asking more about the back end of those things and the work that you're doing and contributing to. Is there a way that you could explain like what makes you proud of your involvement around a deal like an after party studio? Or even the question could be, what could have gone wrong that you that, and it hasn't got to be those specific details, but what makes you feel proud of the work that you've done with an M&A deal, and then what makes you feel like you could have done more, I guess, is the question.
Yes, that's a great question, and often one that's not asked, which is what you are brilliant at and known for. What makes a deal for me like something that I'm particularly proud of? I think when you're doing deals in a space that's evolving or it's fast moving, there's lots happening, there's all sorts of, political changes happening, economic challenges, shall we say, to navigate, but also that means trading environments aren't straightforward. Lots of disruption, hyper growth, like trying to distill down like what is the opportunity, how far can we evidence that? And what really is critical, I think, is keeping that human element of deals. I think we're very good at. And I think it is sometimes lost in deals. It was nice Wade put a comment on the latest post that we've put where we were talking to Ben Gordon about keeping that vision alive and keeping a focus on what it is that you're trying to achieve and not getting too tied into the sort of minutiae of negotiation. And I think with that comes a bit of creativity around negotiation. So what are you actually trying to achieve? And don't just go after sort of specific points that you know are good standard deals. Like obviously that's the hygiene factor. But what are those critical bits that we have to get right for this relationship? Not just to get across the line, but quite often these deals are 2, 3, 4, 5, 6 years, in some instances. That's a long time to try and get right and create enough movement and flexibility in the structure that allows you all to achieve what you're trying to achieve over that long term, not just, yes, it's a great deal on day one, and then in the sort of future, maybe look back at deals done 10, 15 years ago, that upfront payment, exits happen, and then what happens the following years, what happens to that brand? Does it still stay alive? Does it get swallowed? Does the entrepreneurial spirit of the thing stay alive? So that I think for us is some of the bits that we're, and me personally, particularly proud of.
I have a stat that isn't going to be, I imagine, on the website of Waypoint or any
Right,
companies. The stat is that 75% of acquisitions don't work out. And I don't know where that stat's from. It seems to be the industry norm that is accepted. M&A is confusing. There are, as you said, legacy ways of working, clients, even infrastructure, technology. We are bringing two completely different organisms and making them come together. And I guess my question is, what makes the 25%? And can you identify what is going to be in the 75%? And what are you looking for to make sure that, as you said, there is longevity, hopefully immortality to an acquisition when it happens?
Yeah. What makes a deal not work? Right. That there's a few things there, and it's interesting. Sometimes we get asked as an advisor, and this is one thing that I think is a bit more requiring creatives, capital to come together. But what's really important in a deal is we quite often get asked, right, what do buyers want? What do they think this business needs to look like in X years' time? And we, maybe we roll some of that into our thinking of how we position the strategy. And if you step back, it's kind of this imposter syndrome that agency leaders, founders have this brilliant business. And if you think about what they're really doing, that these are businesses that have gone through huge amounts of change. The industry's changed so significantly in the last couple of decades. It continues to pace now. You've got to navigate technology, AI. You've got to changing consumer demands, behaviors. And, you know, there's been some seismic events, you know, COVID days that sort of brought the industry to its knees for a matter of months or years. And you've got entrepreneurs who have jumped the hurdles, evolved their business, changed, and more fundamentally, when you think about what they're doing, right, they're working with some of the world's largest organizations to help them navigate all this change, to stay relevant to consumers. And actually, those are the entrepreneurs that you want to be backing. Their strategy, you know what your clients want, you know where the market's going better than we know. Like, we have a view from M&A, but M&A sort of follows those trends. It's clients are asking for this and therefore we need to buy it. You know, M&A is arguably behind these things. So if you're seeing it on the coalface with clients where the future CMOs are sort of looking and where they want to disrupt, you've got the best seat to that. And quite frankly, the reason that people are wanting to buy is because perhaps they're not there, or perhaps they're seeing it but they don't have the capability. So the worst thing that you can do is sort of compromise your strategy or try and fit it in to get a deal done. Like, it's really easy, relative, to chuck a deal in one end, you know, a mandate in one end and get it out the other end. But people aren't thinking about the future there. They're thinking about getting it across the line and let's see what happens. And I think that's probably a lot to do with where deals go wrong. It's not had the right structure around it. It's not got the right flexibility around it. Or, you know, quite frankly, these are human interactions, right? Human connection is at the center of all of these deals. People might just not get on. Have you spent enough time together? Have you spent enough time talking about the vision and strategy? And you've got to be leading with that. What's your North Star? What's their North Star? If you don't get that right, you're probably not going to get a good deal. You might get a brilliant payment.
Yeah, well, that's it. And again, this is where the ones fall apart. So I'm hearing from that the entrepreneurialism matters, the backing matters, and the alignment. I always go back to the 3 A's. Whenever a CEO asks me, I'm interviewing for this role, what do you think? And I'll just go, right, what's the ambition? Are they aligned? And do you have the autonomy to achieve that aligned ambition?
Yes, exactly that.
A lot of the time, when you find these, you know, everyone has an ambition. It's very rare to find a totally aligned ambition, and it's even harder to find, you know, aligned ambition that leads to autonomy that's appropriately given out. And I look at some of the deals that I've witnessed where it hasn't worked out is generally when you've seen a gobble up situation where it's like big money up front, but the price you pay is autonomy and control of the strategy that you've always been responsible for delivering.
Yeah.
So it's interesting to hear that from your side. I look at, you know, we can be contextual about this and give residents, you know.
Exactly right. Exactly right.
That is the kind of acquirer where they're saying, we're buying you because we're buying what you see the future to look like. You know more than we do. And here is that autonomy to retain who you are and go and achieve that with our backing. We're not going to meddle around with what you've already got because it's clearly working. I won't name the other side of where that's the opposite, but there are other.
No, you're totally right, and you know, a little plug for Can coming up, right? You know, look at Jolien's content around this. He's been really clear. This was the one that he got those three. You know, the founders of OK Cool found those three things in residence, and then the deal sort of folded around it. Like, that was the superstar moment. It was the principles coming together. And then, you know, advisors help make it the right shape and get the thing across the line. But if you can nail that bit, it's the key to any deal.
I love that. Okay, I want to move into private equity, right? Because we're speaking about a flood of private equity money coming into the industry. And I keep on saying, you know, there's this fact that there's $4 trillion worth of dry powder in the private economy. Basically, there's money to be spent. And I think what I'm trying to decipher between is there more money in the creative economy because it's more of an attractive industry? And I've got some theories on that. Or is there just more money in the private economy that it's finding its way? It's trickling through SaaS and tech, and it's ending up in the creative economy more than ever because there is just more money in this $4 trillion. My theory on the former, i.e. it's disproportionately coming to the creative economy, which is, I wouldn't want to be investing in tech right now. I would find anyone backing software, looking at the likes of Claude and AI and the rise of everything that's happening, I would find my capital is in a very risky place. And if I look at the predictability, perhaps it's slower, but it feels to me like it's a little bit safer. People are going to need to be distinguished. They need to be distinctive. They need to advertise because everyone's now got the same tools and they need to stand out. And so therefore, the brand of creativity, the value of creativity is higher. Now, tie that in with the global GDP of the creative economy going from 5 to 10% in the next 5 years. I feel like I'm not just making shit up here. I know it's being disastrously self-serving. That's my theory. Okay, so my question really is it true that there is more private equity coming into the creative economy? And if it's true, why is that?
Yeah, I'd say I'd like to think at least it's a little bit more deliberate than it's sort of tech isn't perhaps performing and therefore we're sort of coming into the creative economy. It kind of goes back to me. It goes back to the piece around disruption. So in markets that are disrupted, you'll have winners and losers, but there's also significant growth opportunity in that. And it's interesting, right? There's two sides to look at it. There's huge opportunity, but there's huge risk in it as well. And we've seen that. So private equity has put significant funding into this. If you look at those acquiring at the moment and think about, well, who's out there? You've got the networks, obviously they're there. You've got the sort of consultancies who've still invested. There's lots and lots of sort of big enterprise businesses investing. But a lot of the ones that people are really wanting to join because they still offer that sort of entrepreneurial spirit are private equity backed. And that's been a huge growth driver of the industry. You've been able to have challenger brands get the funding they need to internationalize, to launch new products, to invest in innovation in a business model that is otherwise more challenging than technology to do that because your margins are thinner in the creative economy. So you've got to think about, well, how can I keep up? How can I invest? How can I build my talent proposition? And that's what's led to entrepreneurs wanting private equity backing. And when it's done well, it works really well. When it's not done so well, you hear the disaster stories, and that's where people get really, perhaps scared's the wrong word, but certainly nervous around going down the private equity route. It's not for everyone, nor is it for every private equity firm. So I think we need to sort of put some shape around that. There are people who understand human capital businesses, understand how they grow, and understand how they scale and how they work. It's not necessarily a linear journey, right? It's not sometimes the revenue growth that you're talking about in tech. It can be. So there's lots to unpick in that question, to be honest. It works really well, but it requires a certain type of entrepreneur to like that route and be up for it. And it requires the right firms who understand the space.
What do you think the challenges are? So if you were advising an entrepreneurial CEO of let's say they're growing at 20% year on year, they're in 7 figures EBIT, they've internationalized, they've got 2 or 3 offices, there's clearly room to go. The brand there's a big total addressable market for this company. And the entrepreneur's going, do I stick and just back this and bootstrap it myself? Do I do a trade sale and I go to Publicis or one of the holding companies out there? Or do I go down this private equity route? What would your advice be to that person when they were favouring PE? What should they be looking out for?
First of all, I'd step back and look at that North Star. So that's where we start with everything. What is the North Star and what are you actually trying to achieve? And all 3 of those cohorts can be creative. All 3 of those cohorts can deliver deals that will align in some shape or form to it. I mean, crudely, the distinction between a trade and a private equity is private equity, you're running your own strategy. And to some extent, in most trade deals, you're folding in, at least to some degree, to someone else's strategy. So I think that's the easiest way to look at it. Now, there's nuance in all of those that even within some of the networks, they can be creative enough to provide a great home and the flexibility in their structures. Is it the exact same flexibility? Perhaps not, but it sort of comes down to what that business plan is, which is why being really clear on that is super important. And what are most people doing when they do their first time? Because presumably that's what you're talking about, first time private equity deals. That is often taking a really strong business that's growing well, it's got great clients, and it's providing some of the infrastructure around it, the sort of capital to unlock that ambition. So there's often clear strategies that they want to execute on, and they perhaps need some funding. Perhaps the balance sheet is, making a couple of million of profit a year, but can we really go and acquire that business there that's really going to open this? Or another thing which perhaps isn't talked about enough, but is a really important point, which is for a lot of these first-time founders, these will have been bootstrapped the entire time. This will have been life savings gone into launching these things. And the good ones that are continuing to invest are putting that cash that's kicked out every year back into the business to expand, to take the next risk on hires, expensive senior. Maybe you're getting into the world where you need to bring in sort of the operational infrastructure. And at some point, just being able to take a bit of cash off the table and park that, pay your mortgage off, there's an element of de-risk that just allows you to swing that bit harder. And the psychology of that can be huge. I think you've talked about it in the past with others, and I know that we've talked about it, but it's certainly for some of the sort of UK founders, it enables you to maybe go a bit more towards that sort of US fail fast approach. It's a crude term, fail fast, but just a little bit more risk appetite that actually by de-risking puts you in a world where actually I'm going to swing for that and I'm going to go all out. I'm not going to sort of half do it, which risks not delivering and executing, but it gives them the ability, and quite frankly that drives a lot of growth.
I can really imagine that. I think there's a thing in there where it's like, are you acting from a place of abundance or you're acting from a place of scarcity? In the US, and you and I have spoken about this a lot, is that everyone generally acts from a place of abundance. So it's a bit like, to the moon until you're not.
Yeah.
Whereas in the UK, we're a lot more, as you say, sort of, we're scarce and we're a bit more, I don't know if we should be going for this and let's, count our money.
Yeah.
Okay, let's say you have 7 figures suddenly in your bank account, right? And you've gone from being someone that doesn't to someone that does. You're now used to the idea of having that. So the lure of that thing now becomes quite a normal thing. And as sadly as growth goes, you always want more growth. And I think if you've never had that and you're putting it off, then I feel like your mentality is you might over romanticize how you're going to feel when you finally get that thing. And part of me wonders, is that where you get the gold medal fever founder who is all in the whole way through, and they end up getting this multitude of whatever exit and it's crazy numbers, they get it and go, is that it? There's something I think about the mentality of like breaking heart, doing something, taking that kind of pressure away from maybe the promises you've made to your family or your partner, and you kind of say, oh, one day it's coming, it's coming. In a way, I'm seeing it as a kind of relieving of that pressure, but also then this huge risk appetite and this kind of abundant brain where it's like, well, if I could do that, then I'm sure I could do the next thing. I've gone on a tangent away from the private equity thing, but for me, that's the lure of it, at least.
It's a foundational thing, right? And the other thing that's tied into that is if you look at it purely through a financial perspective, it's near impossible for us to answer the question that we get asked, when's the right time? And Ben made reference to this in the chat I had to him. Like almost the best time is when you're having the best time yourself. And it then drives the question, is this really the best time? Because the road ahead looks great. Why would I do something now if in 12 months it's even better? And then in 12 months again, it's even better. So it's simply looking at it through a lens of what's a financial return. It can be helpful, obviously, for that point around financial security to take that swing. But when you pull the trigger on it is a really tough question to answer properly. So again, goes back to that, what are you trying to achieve? Because you could go earlier, and if you get the right deal shape with the right infrastructure around you, could you triple this business rather than double it?
Yeah.
And that's the sort of lens you have to look at it through.
Okay, I'll take that and accept that it's a personal thing. And I know that having Jim Houghton on in our previous podcast, Untalented, when I ask what's the first thing you ask, it's always, what do you want out of this thing?
Yeah.
And what's your North Star? I think a lot of the time there is a number, a personal number that they want to achieve, but sometimes there's a multiple because one of their mates told them in a pub, there's all this kind of stuff. One of my questions I wanted to ask was, are there some baseline metrics that a founder should be looking at in terms of checkpoints to even be considering a deal? I.e., in my caveman brain, someone once told me 5 and 1, right? 5 million top line, 1 million bottom, i.e. you're spitting out at least a million EBIT. And the minute you've crossed into that 7-figure moment is when you are going to be more of an attractive proposition to a company. Are there other metrics? Is there like a CAGR? Do we look at compounded annual growth rate where it's like, oh, if you've grown 20, 30, 40% over the course of the last 2 or 3 years, it's a signal that you're doing a good job. A, are those signals good signals? And B, are there any others? Because I'm just being wary of the audience right now. This is for the founder that's probably somewhere near there, that's going, should I be considering doing a deal right now? You're in those shoes. What else are you looking out for in terms of metrics?
I can tell you spent too much time talking to us, throwing out CAGR, and
I know. It's going to be a jargon-free podcast.
Look, I'll answer the question, but the first thing I would say is advisors are really useful, and us and our peers speak to them, speak to us, and get our view on where the market's at, what's going well, all that kind of stuff's really important. One of the things that sort of personal gripe is founders attaching too much importance on some of the metrics that advisors kick out, because you can only ever talk at a sort of very generic level. So you've got to be careful. I think some of the things out there, around 20% profit margins, 20% growth, 1 million EBIT, they're sort of useful guide rails, but that you can over focus on that. And I'll tell you what I mean by that. We've seen some companies come to us, really great EBIT and EBIT margin, maybe into the 30s, but the growth is low. And I think, my reflection would be, well, why are you making such significant margins but the growth is low? You should be investing that and going for the larger growth. So I think over focusing on some of those things, and a margin is one. I would say the biggest generic metric that you can use is your revenue growth, because it talks to scalability. To me, the way I think about profitability, and I always think underlying because I'm an advisor rather than the actual number on the books. But what you then need to think about is, look, if my market's scaling and I'm scaling ahead of the market itself, that's a really good sign, because it means I'm doing something that others aren't, or I've found a really strong niche and others aren't necessarily grasping that. So that means you've got a strong business. It's all relative, right? So, once you get up to sort of double-digit revenue figures, 30%, 40% growth is like significant. You must be doing something really right there. So that's the main metric for me. I then think about it in a really sad sort of finance world way, where are you good at consistently delivering that in a profitable way? Now, that doesn't mean that you're not investing. So you can invest. And if you can show, look, I'm hiring the next team that's driving the next 5 million of growth. But at some point, that needs to start showing that you can deliver it profitably. And that's what I mean by the sort of underlying profitability. What I would really urge people not to do is hamper growth because you're protecting that 20% margin. Now, obviously, deals are done eventually largely on an EBITDA. So you've got to be careful at the right time. But equally, coming back to your point about multiples, and advisors, again, terrible at their use of multiples. To me, a multiple represents both the future scalability of the business and the consistency upon which you can deliver that profitably. I.e., if you're flying and you can turn that to profit in the future, you're going to get a much higher multiple than something that's got really high EBITDA but low growth. And therefore, you can still get an incredibly strong deal as long as that underlying profitability is there. When you take it to the extremes of, well, we just keep investing and we can't prove that any of it can be delivered profitably, you question the second part of what I think the multiple is, which is the sort of consistency of margin. So I would say that is the critical one for me.
There's an example I want to show you, because I believe there's a founder that we know that's going through this right now, and I think we'll get a very unfair valuation based on where their EBIT is. internationalized. They've reinvested and reinvested. They're only 8 years old. It's in a very high growth market, which is sports, and they're doing very well. If they played the EBIT game, they'd probably be about 2 or 3 million EBIT by now, but they're not. They're about 800/1 million. However, if they flipped it over the next 2 years and hampered their growth, they could very easily show 2 or 3. But the problem with that is if you're the buyer, when you go to buy that company because you've waited for them to become EBITDA positive, you won't be the only bidder. So, and therefore you could end up paying a premium. So the question I have is, how many buyers are out there that are willing to look at a company that have clearly got...
Great question.
And what do you need to do to tell them that, look, this is going to be a good deal. Do you want to share the risk with me and give me the valuation that I'm probably going to get in 2 years' time?
That is a brilliant question. Not every buyer is set up to do that. So the pool of people who are going to do that is lower. Like, you need to recognize that. That's not counter to my point. I still think if you're trying to develop and you're shooting for that North Star, you should do everything you can to get there. The people who get it, get it. The people who don't. So you're not going to convince the people who don't believe that and don't see that opportunity coming through. Or maybe, have you shown that consistently? Is it a bit of a flash in a pan moment that you can't show that consistency of how it continues? And that's a separate point. But you're right, it's not every buyer that's going to put that. How many deals are there out there that are at those crazy multiples? There's not that many. And it's because you've got to find that alignment. And that's where it requires creativity and deal structuring. And quite frankly, it requires the principals to really believe, both buyer and seller, that this is the right thing to do.
Yeah.
Going out and running a sort of hard auction on things like that, where it's sort of unproven, perhaps not the best way, but again, there's also a question mark around that, which is, for that business, for instance, how can you sort of, using evidence-based negotiation, how can you show that underlying profit should be there?
That's a hard one. I'm interested in the profile of that buyer, because if we presume that there's trade and PE in this instance, I've not met a PE firm or even a PE-backed founder that is operating on behalf of the PE firm ever be convinced to acquire a company that isn't mathematically de-risked and clearly a good asset. If saying that, we want to be bought at the valuation that we think we deserve to be bought at, but we're willing to be paid that on the earn-out, is there a way of cutting that differently? So perhaps the money up front that they would get, and actually for the listener, for the person that's thinking about doing a deal, what would be a typical structure?
You're right. It does come down to structuring. There aren't, like you say, there are PE-backed groups, Residents being one. Yeah. That is PE-backed. And there are others. There are other great businesses out there doing this. Even the networks can do this. For what it's worth, and some of the big sort of entertainment groups, that they are needing to be more creative, and they have evolved themselves, which is why they're winning now. But to answer your question, yes, it is down to structuring. I think the more that you are selling the future, the more the question is, both from us, we challenge founders on this as well, but also the buyer's going to ask, well, if you believe in the future, why do you want a deal that's short or that is about maximum cash off the table right now? And this is where nuance comes in. I don't think there's a one rule fits all type thing for this. It might be that you've got a number, right? To your point, you've got a number and you need that for the ability to go and swing harder. Like that needs to be right for founders. Equally, if you've got a business that's growing really fast and that's coming through next year, but you want to go now, you shouldn't be penalized for wanting to go earlier if there's that alignment and actually together you're stronger. So in those instances, you might find that you get paid more on day one because it recognizes. Equally, you might have an integration immediately. It really depends on the opportunity. And I know that's a tough one because it's sort of classic advisor, well, it depends. But it is really shaped around what the opportunity is and what you believe. And I'll give you a good example, right? If you're doing a sort of minority private equity round, you are going to be a buyer as well as seller. And therefore, you come with both hats when you're thinking about that. where do I see this business going? What's my number that gives me security to pay down the mortgage, school fees, just a bit of safety that allows me to focus fully on the business. And that number, you'll flow it in. Equally, what is fair? There's also a level of what is a sensible deal structure. No one's going to go below that. But then there is do I take it from this multiple to this multiple? And what does that do for me as seller and buyer in this instance? So there's quite a lot to think through, which is why I think you should always speak to advisors, not self-plugging.
But let's say, so a third. The theory there is that you get a third of the money is off the table and into the founder's bank account. Thanks very much. The next third is into the business. So what money we're using to then grow the company. And then the last third is normally shares into the wider pool. But that would make sense if it was a trade deal. Would the third still work if you are still the major shareholder? Because you wouldn't get the third as the shares rest in the business, would you?
From what I'm seeing in the market of PE-backed trade deals, which I think is what you're talking about there, yes, there's an element of cash off, like the de-risk, this is where you've got the business to today, that's what we're buying, that's what we're paying for. There's also the premium there of, look, we might be folding into your strategy. So, what happens if our business does really well, but that, we lose some autonomy that we can shape this, and we are ultimately handing over control to another party. So, there's a premium to that. Mm-hmm. Then you'd ordinarily have some sort of, again, depending on the deal, but a lot of PE backed, maybe a short burst earn out, or earn in, which is based on your own sort of performance metrics and proving out the growth that you said was there. And then, there is usually a component of buying into the group with those, because what people are trying to do is avoid the sort of ring-fenced company mindset. And the bigger opportunity with those groups is, look, we're building something together. And if you truly believe in that, then those shares should be worth something in the future, in quite considerable amount. So from a founder, we sometimes get asked, do I really want to take shares in another company? Well, it depends what that company is, right? There's two hats to look at that from. One, do you really believe in the business that you're going into? Two, what do you perceive that to be worth? Like, are you baking that into your deal value, or are you saying, well, I'm happy with the deal and that's a sort of cherry on top? And in the world where, things do happen and growth isn't always linear, all it takes is a client to put some big spending on pause because there's some new conflict, or there can be things that aren't underlying business changes but can just stall growth for a year. And if that hits your sort of earn out, earn in period, well, maybe there's a de-risk of, well, I'm still getting upside in the wider 4 or 5 year journey that I'm on with the group.
Yeah.
So there's lots of things to weigh up when you're considering those sort of deal structures and the different tools.
Okay. I'm happy on that. Before we move on to your predictions, I just want to get a state of play. I've written in my pre-call notes, where is the market busiest and why?
In some ways, it's a really obvious answer, which is high growth, innovative businesses are always in demand.
Yeah.
I think that for the last few years, there's been a change where average businesses, or sort of things that aren't scaling or in hot parts of the market that aren't innovators, I think maybe in the sort of years gone by, you would have found an okay deal. It's not like a standout, but you'd sell the business, and maybe that would reinvigorate some growth or help you do what you're struggling to do. I think those days are probably over at the moment. There is a really strong market out there, but it's still jittery because AI's disrupting and what happens to the agency model. I think that there's lots of things to go through. So for high growth innovators in even slower growth parts of the market, what's fair to call slow growth, and maybe lots of people have a dig at me here, but like traditional brand creative is not necessarily viewed as the hottest, fastest growing part. But there's really strong brands in that space. There's really strong independents who are changing the style, changing the business model, helping brands navigate in a new way. And that will spur great deals still.
Yeah.
So I don't like to tarnish parts of the market by saying, well, that's not interesting. And yeah, maybe that means that not everyone's going to invest in it. Again, coming back to that, private equity is not for everyone. Not all PE houses will go into those parts of the market, but there will be buyers for it. Yeah, fast growth areas of the market are particularly interesting. The creator economy as a whole is red hot. Lots of activity there, but people are still wary about where the industry's going. So it's really strong, but things can be a little jittery out there still.
Funny hearing you say that, and just hearing you say the creative traditional advertising part, you could deem it as slow growth, but then also there are some huge brands in there. And I asked the question, what have those brands done differently within the slower parts of the market? They've innovated, they've evolved, and they've become more attractive. One of the biggest things you could do right now to become incredibly valuable as an asset in that part of the industry clearly is pivoting into social and creator. Because right now, if we accept that Fabric, OK Cool, and nearly all of the independent social agencies that have scaled to beyond 100 people have gone, there is a demand, a huge demand for high growth, social first creative agencies. So if I was in the creative agency's shoes and I'm going, right, we need to reimagine how we do this thing, the first thing I'd be doing is hiring in a social professional that understands the mechanics of social media and injecting them with someone that deeply understands brand and understands the modern Internet of Things society that we live in. And the companies that we're seeing that are doing really well, that are kind of wearing new clothes and stepping into that world, they will get a brilliant valuation. If they've evolved into influencer, even better. And that's awesome at that end. At the other end, what would have been, I would say, like traditional design and branding. We don't get asked, well, we get asked occasionally for design and branding agencies, more from companies that want to get C-suite connections. You could have a social media agency that are, messing around with heads of brands that want to be in there with CEOs. Really smart way to get up the ladder is to hire a branding and strategy consultancy, because guess who they're advising? CEOs. So we're seeing that in tiny instances. But the one thing we are seeing that we think is really interesting are those companies are moving into the consultancy lunch, where they are starting to sell workflows. They're starting to consult on AI. They're starting to help co-design and build agentic working flow systems, whilst of course building design systems and everything else that goes around it. So we're seeing this kind of resurgence. You could have said that product digital agencies were dying at one point, and now they're rising back up again because they figured out, oh, this is the kind of stuff where there's efficiency and growth to happen. We're also really well set up to make it look pretty and also for it to make sense and flow properly. So actually there is huge value and we're back to growing again. Yeah. So it's funny, you're right, where there's barren land, sure enough, there'll be green shoots coming up from again because no one else is in there innovating. So I love that.
That's what I love about this industry, right? And it goes back to that first point around like the creativity in this world and entrepreneurialism. It's almost unmatched elsewhere. You look at tech, but it's a different type. I'd say the creativity in the creative industries is brilliant, and it does drive so much growth. I think to answer some of the questions you haven't asked, but you're sort of posing in how you're framing that, there's going to be huge disruption in this industry, huge disruption. And the thing that I'd like to see is who are those new big players that are going to be dominant in this world. We've seen the challengers rise, and we've seen some really good challengers. Who are those ones that establish themselves, and who are the new challengers who come in, and they're going to be perhaps the ones who come with some more creative deal structures. I do think the deal making world will need to evolve with it, because it's not going to look the same. It might be a 15-person business with your senior strategy people that the CMOs want on the end of the phone, doing those workshops on how do we stay relevant as a brand, where do we need to go, powered by a sort of technology workflows in the background that do the heavy lifting of what would have been 60, 70 people. So that's going to be a different buying, and certainly people need to think about structuring those. But that they can have huge impact, but it might not be in your traditional scale or necessarily traditional metrics. I think the other bit that's really interesting for me is where does that come from? And this is where I'm excited, and that's why I like the after party thing. Is it a studio that comes in? Do the studios, which have always been quite tied to advertising, in the sense of advertising used to fund a lot of the content with, the traditional ad gaps between content. They've always been tied together as industries. Is it from the talent world where that used to be Hollywood talent? Now it's creators are becoming equal talent. So it could come from any of those, or people go out and bespokely build the thing. And we know, common interest is a great example of that. The creator economy as a whole, I believe, has set this sort of epicenter of activity where you can come at it from each of those angles. And if you can tie it all together, so what's the next thing that you could do? And talking about some of those design agencies, someone who understands how to speak to creators and maybe is a creator, someone who understands how to commission entertainment, has parts of that world, who can create IP formats for those creators, people who can design brands that creators want to launch or talent want to launch. There could be a whole new ecosystem of who knows what that looks like, but like you can see a really exciting business model there as a sort of agency of the future that pulls all these things together. Traditionally doesn't sit together apart from in the networks, and it's quite separate in some of those. But if you've got this thing working together, doing really exciting new work. But again, that's not going to be for every brand to start with. There's still the legacy brands who need to do things a certain way. They need safety. They need the sort of standard ways of doing things. But that's the exciting thing, I think.
Agreed. I think you put that really well. There's the whole attention economy, and the attention is the new oil, the
Yeah.
rise of the creator. And you can see why GDP is going to double, because all of the money is flooding there, not just in brand money, but in consumer money. And there's entertainment, TV, broadcast, like Sidemen selling out Wembley Stadium. There's in real life experiences. There's all these different ways of gaining attention that feel more authentic and real, and isn't someone eating a bowl of Cocoa Pops.
Yeah.
So I'm as bullish and excited about this industry as you are. I think we're going to attract lots of new competitors that are going, hold on, what the fuck's going on over there? But we will have the legacy and understanding of how all this came together. So we'll survive here. I would say, just on that point, we mentioned After Party Studios, you mentioned Common Interest. I get very excited about a company called OBB Media. Again, it's an LA Hollywood based thing that's come out of knowing lots of talent and entertainment, and then boom, you bring in James Rowe from Adam and Eve DDB.
That's it.
He gets it. He understands how to sell to whatever brands. They've pumped out a campaign recently, which is a Kevin Durant. He's got really ashy legs, and it's a CeraVe thing, and he's the face of legs, and it's a complete piss take about how people have been taking the piss out of his legs, and he's agreed to it, right? And he's agreed to to be this satire. It's that kind of Ryan Reynolds maximum effort.
Yeah.
Like plonk the celebrity to get them to take the piss out of themselves, and you watch how that catches fire all around sport and entertainment. And Jesus Christ, you've not even covered that as a way to start. Like you look at entertainment, physical things are being bought, museums could get acquired. There are so many things that could be acquired as central places of IP that you can then build ecosystems and storytelling around it. All right, well, let's move in. Let's move in, baby. We're into the thick end, the meat, the business end of this podcast, which is our three predictions. Sorry, your three predictions, Mr. Matt Lacey. So I hope this has been keeping you up at night. Please take us through your first prediction.
First prediction. I think AI is here to stay. It's huge. There's going to be huge disruption. From that, I'd say there's a key one, which is that human creative intervention is going to be critical. So we're already seeing it. The new generation as well, perhaps seeing previous generations over-indexing on it. And this is stepping slightly out of my lane as an advisor and back into the sort of seats of the rest of the audience. Perhaps over-indexing and the sort of comeback of in real life, like human connection. And I think the interesting thing will be how that's tied to the technology, but it's going to be led from this industry. No one else knows people creative better. And so that's a really exciting one for me. I don't know what that looks like, but I'm excited to see this will be the industry that solves it, for sure.
We're going to say this is the industry that solves the AI dilemma by making it more human, and there's value in that. Love. Okay, what's prediction 2, please?
Prediction 2 is kind of as we touched on. I think there is finally a collision of three mammoth markets in talent, entertainment, and brand, and we will see increasing numbers of those common interest type groups come together. That has to be the case. If I'm wrong, fair enough, but I don't think so.
I like that.
I see it coming.
I like that. Final prediction.
final prediction is there's going to be a new breed of agency. This like highly strategic, senior-led creative business powered by technology. And that means completely changing the way that agencies work and therefore charge. And again, to me, that's going to require some new deal making approaches from both buyers, sellers, and advisors throughout the industry. And we're already seeing them, right? They're already emerging out of some of the networks, out of some of the independents. They are coming. So I think they're going to start to really shake up the model and perhaps be the ones that start putting real pressure on the sort of traditional agency model alongside brands.
100%. You can see the intangibles, fundamental like this is happening left, right, and center. Moving up the consultancy ladder, the upside down triangle, i.e., it's fat up the top and it's thin at the bottom, and it's generally made up with agentic AI.
Yeah.
Awful news for the junior side of the industry. However, I'm sure there's a route to get into those kind of businesses as a junior person. It's hard, man, but I guess that's not what we're here to speak about.
Yeah, well, it is, but then perhaps with those, it goes back to that point I'd made earlier on around the traditional agency margins. If these are higher margin business and they've got a slightly different model, well, great, then we've got way more of our sort of capital, our own capital to invest in talent proposition and thinking about solving that problem. So, look, it's not going to be that the seniors today are the last creatives in the industry, right? Hope not. So it will be solved.
It's a really, really good point that no one said. Like, we're in this weird moment right now where the margins need to get fatter, and they will, because there are fewer people doing the job, and there's this, new AI software or whatever in the middle of all of it. But they are going to die, and so therefore, if they want to sell their companies, they will need a succession plan. And you can't
Something
just
for you to look through.
well, look, all of this is about being, immortalization of these agencies that we're building and growing and selling, right? There needs to be a strategy. Otherwise, no one is going to be interested in partnering, buying, acquiring, using your agency or business if you haven't thought of a way that mum and pa or grandpa and grandma, don't eventually step away for the grandchildren. So I think that's really nice. And you're right, it's going to be in the confidence of the larger margins that they've got, and therefore the cash to take bets, to take risks, to maybe buy in a new funky strange studio that some kids have put together and upskill them and teach them the new way. The biggest myth, I think, and I think the biggest thing that particularly the boomer category struggles with, even millennials as well, is that they have to do the same 10,000 hours that we did. That's what's changed. The 10,000 hours, the entry point, the barrier to entry now to getting into it looks different. And guess what? It's less drudge and it's more strategic. And if anything, the new kids that are coming in should be and will be much more reasonable, much more strategically minded, because they've got the tools to do the boring, making cups of tea and scribing notes from meetings and shit that you had to do to get into this. So
I hope so.
we romanticize that. I think we put too much value in the shit work that we had to do to get where we are.
Oh yeah. I had the exact same conversation with someone the other day. He was like, "Yeah, look, I what would have taken you 3 weeks, 2 years, 4 years to learn, I can learn in a day."
Right?
And that was eye-opening. But what makes that successful is as long as you maintain that sort of critical thinking and don't let the AI do that for you. And the curiosity, I mean, for me, curiosity is everything. That's what drives the most successful people. It's wanting to know why that's the answer. And, for someone like me who's really irritating when, when I was a junior, it's like, I don't believe that's the best way. I'm going to do it my way.
Yeah.
Then I find out why I'm wrong.
The beginner's mind, baby. It's
gotta do
always
it.
we're primarily designed in our 20s, particularly early 20s, to reject the status quo because that's our survival technique. We're designed to. So like you just know that what's coming up the ladder are people that think differently because they're fucking trained to, and they're biologically evolved to think differently, to move on our species and do things differently. So I have no time for the rhetoric of, well, back in my day, yeah, of course, that was your day, and now it's not your day, it's some other dude's day. I think that this, as it always has been and as it always will be a phenomenal opportunity for junior talent to get involved, but we need to do our best in opening the gates for them to come and have a go. Matt, I've loved this. You're a legend.
Yeah, likewise. And I love the way that you've ended in a typical Ollie fashion on the human element again.
Oh,
Nailed it. Nailed it.
thank you, sir. And you nailed it too. Mate, thank you so much for
Yeah,
this.
of course, it's
And
been
we'll
brilliant.
see you out in Cannes with our bad CEOs.
Certainly will do.